The Federal Reserve has jacked up the stock market and it directly affects your money. So this video is really important because we're going to explain how the market is going to move over the next few years due to the Federal Reserve. And we're going to see extremes here, extreme bulls and extreme bears, and it's all going to lead into a big market crash, which sucks, but at the same time, there's opportunity to make a lot of money here too. And you'll see what I mean in these next few minutes. Now, you guys know that I co-founded the global macro research and consulting firm called MacroOps that happened a few years ago. And nowadays, our clients include some of the biggest investors in the world, managing billions of dollars. Our team's analysis goes out to them every day. And one of the most important things we do for our clients is track and analyze what the Fed is doing. And that's because the Federal Reserve has a lot of control over the amount of money in the market, also known as liquidity. And this liquidity is extremely important. As the billionaire legendary investor Stanley Druckenmiller said, earnings don't move the overall market. It's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity. Most people in the market are looking for earnings and conventional measures, but it's liquidity that moves markets. So liquidity is the most important thing to track to know where markets are going. And who controls liquidity? It's the Fed. So what we're talking about today is a huge change that the Fed made that is affecting liquidity and therefore the entire stock market. So let's jump into the details of exactly what's going on. And of course, we're going to use our research from MacroOps. And my partner Alex released this new research piece called the Fed's New Reaction Function. So all of us in the market right now, all us market participants, we are playing a very different game today than just 12 months ago. And that's because our game masters, which is the Fed, they have changed the rules. And that's what we're talking about when we get into the Fed's New Reaction Function. See, the Fed has made a big shift in their monetary policy. And monetary policy is what we do with our money supply. So it's the Fed printing money. And then when you hear about fiscal policy, that's more about the government providing stimulus, like the stimulus checks that we got, or putting together different laws, reducing taxes, things like that. But when we're talking monetary, we're talking the Fed because we're talking printing. So normally the job of the Fed has been to carry out its dual mandate. So they're supposed to do two things: keep unemployment low and keep prices stable. Meaning manage inflation. They want to keep that at 2%. So it's always been a balancing act, right? They want to stimulate the economy so that unemployment is low, so that everyone has a job, but at the same time not stimulate it too much so that inflation gets out of control. So it's constantly going like this. Now, in order to do that, to keep that unemployment low and prices stable, they would run a counter-cyclical monetary policy. Or in more simpler terms, they would lean against the wind. And what's that mean? Well, if the economy was naturally running hot and everything was super great, the Fed would try to cool it down a little bit. They would raise interest rates and make liquidity a little more tight. Their thought being they don't want inflation to get out of control, so they'll manage the economy a little bit. And then they would do the same thing on the opposite side. When the economy was doing naturally poorly, they would start stimulating, printing money, lowering interest rates, trying to get it back up to that average. So every time the economy was running above average, they would try to bring it back down. And every time it's running below average, they would try to bring it back up. And that's what Alex says here. When they perceive economic activity to be waning, they boost output by lowering interest rates and easing financial conditions, providing more of that liquidity. And then when the economy is running too hot and unemployment is at a low level that they think could lead to higher inflation, which they don't want, they tighten those conditions. But now the Fed has decided to do the opposite. Instead of leaning against the wind, they're going to start leaning with the wind. They changed their reaction function to how they react to the economy. So instead of running a counter-cyclical policy, they're just going to add fuel to the fire. So basically, when the economy is good, the Fed is just going to try and make it better. Where before they would try to cool it down, right, and say, hey, we don't want inflation to get out of control. Now they're just going to put the pedal to the floor and let it run. Oh, economy is doing great. Let's lower interest rates more. So that's what we mean by leaning with the wind instead of against it. So basically, the Fed realized that their mechanical approach to their monetary policy wasn't working, and it hasn't been working for some time. So instead, what they want to do is switch to flexible average inflation targeting, which is a fancy way of just saying that, hey, you know what? We've kind of been undershooting our inflation target for 2 decades. And as a result, we've created unnecessarily high unemployment and plenty of human suffering. So you know what? Let's let inflation run above target for a while. Screw that 2% level. And actually, let's let it run a lot before we even think about letting our foot off the gas. The Fed doesn't want to be the party stopper anymore. They want to be the guys keeping it going, the guys bringing out the shots, the guys providing the market with that illicit drug that keeps it going, liquidity. So back in the day when the Fed was running their normal policy, leaning against the wind, the greatest of all time, Stanley Druckenmiller, he said, the best environment for stocks is a very dull, slow economy that the Federal Reserve is trying to get going. Because once the economy reaches a certain level of acceleration, the Fed is no longer with you. But here's the thing, that doesn't apply anymore because now the Fed is with you. They want to reflate the economy. They want inflation to run above that 2%. They want to see how low they can drive that unemployment number. And again, you got to realize this is a massive, massive shift in the Federal Reserve because they're basically doing the opposite of what they've done forever. And think about the scenario that we're in now. There is a ton of pent-up demand because of this whole pandemic. A lot of money saved up, a lot of people cooped up, ready to go, ready to get back into the real economy and spend their money like crazy. We know we're going to see that happen as soon as this pandemic is over. So when that happens, the economy is likely going to boom. And along with that boom, you had the Fed pouring gasoline on top of it. So what we're looking at here is a massive, massive bull market, like a late 90s bull market, just insanity. And it's crazy to think about because we've been in a bull market since 2009. It's been so long. But not only is this going to be the longest bull market, but it's likely going to be the craziest too. Because as we explained, the Fed has changed. But then the question is, what does this mean? Does this mean that markets are going to go up forever now? No, it does not mean that. Things haven't changed that much. What's really happening here is we are setting up for an even bigger disaster in the future. A massive, massive stock market crash. And let me tell you why. So the whole point of the Fed's previous dual mandate was to keep things stable, right? The economy. When things run too hot, bring it back down. When they run too cold, bring it back up. And that's supposed to balance everything out so that even though we move like this, over time, it's a nice little curve like this. But now what the Fed is doing is accentuating the upside. So if normally you would go up to this point before you crash lower in the economy, the stock market, however you want to look at it, now we're going to be going to this point and crashing from here. So just imagine how painful and big that crash is going to be. Because what do we know about that 90s bubble that we went into? It crashed hard, right? And if this bubble in this bull market is even bigger and it's going to get even crazier, just imagine the aftermath. And that's what you always got to think about because a lot of people don't want to think about it, but you always got to look at the downside in the market. And the scary part is that if the Fed is doing this and pumping the market higher, another effect of that is that they don't have any tools left in their bag to actually help the economy when it naturally falls. Because the thing is, when you're raising interest rates when the economy is doing well, you're also raising them so that you could lower them later when the economy is doing poorly. But if we keep interest rates super low and we keep cutting them while the market is taking off and the economy is doing great, then what are we going to do when things are naturally rolling over? We have nothing to pad the downside anymore. It's that out of bullets scenario that you've heard about time and time again. And it's interesting because you hear about the Fed being out of bullets every time there's a crash, right? So 2008, even the March 2020 crash, but somehow every time the Fed is able to print and bring us out. But here's the thing, every time you print that money, it becomes less and less effective. And yeah, we thought it wouldn't work these last few times, but it did. But that doesn't mean it's going to continue to work because what you're doing is kicking that can further down the road. And the more you kick it down the road and the more you let all this rot in the system, the more you let it build, the bigger the fire is going to be. That's why people who manage forests, they have little fires, right? To clear out the underbrush so that there's not one huge fire that takes everything down. It's management. But the Fed seems to only want to manage things one way. So again, what's going to happen when the market falls and the economy falls? They're going to try and print more, but it's going to be less effective. So they have to print even more. And this is what Ray Dalio talks about. He says this happens to every single empire, where eventually they decide to print so much that they destroy their own currency because they're trying to get out of whatever mess they put themselves into, which they aren't able to. And that's how the empire falls. So that could be very well what we're going to see with the US dollar because of the actions that the Fed are taking right now. Now, again, we don't know when all of this is going to happen. And that means this isn't the time to take your money out of the market because, like I said, this is going to be a massive bull market over the next few years at least. And it's during these times where you can make the most amount of money. But it becomes tricky because you don't want to be caught when the market does eventually collapse. So that being the case in this market, there is something extremely important that you need to be doing. So important, I made a whole video about it, which you can see right here. It's honestly the most important video I've ever made, and it is crucial to watch to make it through these types of markets that we're facing nowadays. So click here and I will see you in that video.